Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another weekly economic review, this time for the week ending September 17, 2021. So, as usual, we'll start with a look at this week's markets at the close on a Thursday. So, positive returns for bonds, 0.08% for the universe index, 0.33% for the long index, and 0.10% for corps. So, another positive week here for bonds. Year to date, we remain in the red. Equities, the TSX underperformed the US markets this week, minus 0.09%, while in Canadian dollars, the S&P 500 and Nasdaq were positive at 0.3% and above. EFI, so Europe and Asia down on the week. Emerging markets very volatile these days, so minus 2.5% in Canadian dollars on the week. Many are asking the same question, and we are wondering the same thing. Is it time to jump into emerging markets? When you look at the relative valuation of emerging markets versus other markets, you can make the case that it's a very interesting place to put some money for the long term. But in the short term, we would remain careful about the entry point. There's still a lot of volatility. The China situation is still concerning, so we would remain careful with this one until we have more clarity. And when we decide that it's time on our end to start putting more money at work into emerging markets, we'll keep you posted. But emerging markets, always very volatile, always a risky bet. So we would advise everyone to remain cautious with this theme in these days. So oil up 4% on the week. And in fact, this is the WTI. The Brent index, which is more the global price, touched $75 for the first time in a few years this week. So some momentum on oil. Canadian dollar followed suit higher, but euro down, and gold very volatile these days, down almost 2% on the week. So COVID, again, sorry to bring these negative charts, but this is where the story is these days. Israel, after removing the indoor mask mandates and removing the social distancing measures, they're fighting the worst wave. And as you can see, there's a lot of volatility around that wave. And if you look at the chart on the left, if you look at the USA, UK, Canada, you do see some wiggles in the last few days. So governments are starting to put some more measures in place. So it's and misses left and right. But the fourth wave that we're fighting now remains a very real risk to the economic outlook. And again, I repeat, if you have more cases, you have more hospitalizations. And if you have too many hospitalizations, that's when the governments need to do something and maybe close parts of the economy. And this is what the markets don't like. So that's why I always bring this every single week and talking about hospitalizations. In Canada on the right, you see that Alberta, pretty much the worst wave, or we're headed towards the worst wave of all waves. So fighting this very dearly. And if you look at the Canadian average, Quebec, Ontario, BC, you do see that even though the level looks good, the trend, the trajectory is not what you want to see. So still very much a live risk to the economy and the markets. Now, the story in the markets is inflation. So I thought I might delve in a little bit deeper than in the past few weeks. So here you have the inflation for Canada and the US. Canada in red, of course, the US in blue. So on both sides of the border, you're outside of the target range of the Bank of Canada and the Fed. So their monetary policies to keep inflation within a range of 1 to 3%. And if it goes over or under, typically needs to act to curb that thing back in. So first thing that we notice is the divergence between the US and Canada recently, and it's pretty much all explained by something very simple, in the fact that in the US, they account for the price of used cars in the index, the consumer price index, and in Canada we don't. It's pretty much as simple as that. If you remove that component in the US or you add it in Canada, you pretty much have similar figures on both sides of the border. So not much divergence between the two countries, in fact. But in the US, we're starting to see a topping off of the inflationary pressures, is because used cars and trucks, the prices are starting to fall back to earth. Of course, this summer, if you wanted to buy a car, New cars were hard to get because of shortages of chips, which led to a shortage of cars. So everyone went towards the used car market. So prices rose by 33% over the summer. So and now it's starting to fall back to earth, and every people were going back to work to needing a new car. So used car prices reacted accordingly, but now starting to taper off a little bit. But still, as you can see, the pressure is really strong recently, and the question is, well, is this transitory or not? So let's dig here. This is a chart for Canada. So I kept the same colors here. This is from Scotiabank, but goods are in red and services are in blue. So as you can see, for both services and goods, the prices are going higher. So social distancing it means that businesses are less productive, so they're pushing their prices higher. The price of goods that you use to produce is also going higher. It's hard to get labor in the services sector still because of COVID fear, so you need to pay a little bit more to attract workers, so that pushes the prices higher. But for goods, the reason is mostly because of shipping costs and bottlenecks. So everything that we use every single day, like smartphones here, you have like books, you even have like coffee cups here. Everything comes through containers now, and the cost of shipping a container from one major port to another in the world went from on average 1,500 to $2,000 before COVID to now $10,000. So it's a factor of more than 10. So that's why the price for goods are going higher. Bottlenecks and shipping costs are pushing the prices of these goods much higher. So services inflation, social distancing, the measure having to pay your employees more is pushing it. So we do know that the bottlenecks will be transitory. So at some point, it's gonna fade away. But it could be transitory for longer than we think. So I would not be surprised if it through 2022 we still see inflation above 3.5% through the year because of these factors that are very real right now. That will fade eventually, but still it will take some time to sort itself out. But now the if we look at things this way here, so on the left you have Canada, on the right you have the US. So this is the path of the consumer price index. So in both countries you have statistical agencies that do surveys, that they look at, well, what does the typical household consume and what are the price of these goods, and they build an index. So you have the CPI on both sides of the border. So it's different CPIs, different definitions for each countries, but still the same concept. As you can see, the price of goods fell during COVID, and then there was a catch up period of higher inflation because you were catching up. But now we're above trend, and the question is, well, how long will that last? Well, I said in the short term, probably the shipping costs bottlenecks will fade away, but we need to look at wages, wage pressures. And in the long run, we do think that wage pressures will be the determining factor, and wages should rise with labor shortages over the next decade. So that should still be a factor that plays in, and we don't know how long COVID will be around in some services sectors. Pay more to attract people who might be fearful of COVID. So all of these factors may make for a transitory strong push in inflation, but after that we should taper to a level that would be above what we saw over the last decade. So if you're used at seeing 1 to 2% inflation, could be between 2.5 and 3.5% for a good while. So very important economic aspect, very important for the purchasing power of households and for the financial markets. So we'll be keeping you posted on all of the developments that are linked to inflation and to the labor market and to wage pressures over the next few months and years. You can count on us. So now financial markets. The buy the dip strategy is the theme of the year. So here you see this is the S&P 500. If you count them, that's 9 times that we've been bouncing on the 50-day moving average. So we're not technicians. We don't base all of our strategies on technicals, but technicals in this kind of juncture. We've been showing a lot of charts recently about long-term relationships not holding, maybe market being stretched. So when you have some risk factors in there, but the market keeps grinding up, that explains why we're neutral and not defensive, because we want to participate in this market. But you need to look at technicals, because a lot of people are trading on technicals these days. And as you can see, whenever we touch the 50-day moving average, some new buyers come in, and they tend to be, the data that we have show that they tend to be retail investors. So it's you and I, and not personally, not myself professionally with the funds that we manage, but it's not the institutional investors, it's the retail investors that are buying the dips based on the data that we have. So now we need to ask ourselves, well, can this last? And recently, this week, we had the survey of investor sentiment, the AAII survey, well followed survey. And here you have the spread between those that say that they're bullish on the market and those that say that they are bearish on the market. And as you can see, this week it just fell like a rock. So it seems that we have maybe a pause here in investor sentiment. So that leads us to wonder if buy the dip can last for how long can it last. So that's one thing also that's a concern to us. So until we go through the 50-day moving average with some conviction, well, there's no sign that we have broken the pattern, but we will be very, very mindful over the next um, few weeks about how sentiment evolves on the retail side and if that impacts the behavior of the market. But very important development here. Finally, it's rare that I dig into specific stories like that, but in global markets, the China Evergrande story is becoming more and more important. So if you followed the news, you've heard that in China, you have those big real estate developers that are starting to run into problems. You have an economic slowdown, and they have so much debt now that it's hard for them to even pay the coupons on that debt. So that leads to a systemic risk here. So on the left, you see the Hang Seng Properties Index. So on the stock market now, it's not just Evergrande, everyone just is selling their shares of property developers, so starting to fall. So it's a big risk. But on the right, most importantly, the high yield index, so the spread, how much do you have to pay on top of the interest rates of the government to borrow, or at least to lend money rather to businesses that are of lower quality. So how much it costs for these businesses to finance themselves. And as you can see now, the spread is even higher than it was at the bottom of the COVID crisis. So that means that access to capital for these firms is very tough. People are dumping these bonds very quickly. So there is a risk of a systemic shift here, systemic wave within the bond market in China. So of course, China is very good at managing these kind of situations, but we'll see if this time it's too much, because I mean, it's not exactly the same thing, but Lehman Brothers in 2008, it was 60 billion that they had in liabilities, but it was an investment bank. It was very much at the center of the financial system with all of the other big American banks. Here it's 300 billion, so that's 5 times as much, but it's not exactly the same as an investment bank. So that's a big question mark. So I thought, well, at least I'll mention it here, keep you informed that it's a risk, and we'll keep you posted if there's any developments. But this is one thing that could turn into a systemic risk if anything bad happens. So what to watch next week? Retail sales in July, it was higher, 4.2% higher. In August, we kept reopening the economy, so we'll see if it remains on an uptrend. In the US, housing starts, we'll have the Fed decision, FOMC rate decision. That's a decision of the Fed. Should be unchanged on the rate, but we should hear more about the tapering of its QE program, quantitative easing. So we'll be looking at that. And market, manufacturing PMI, and services PMI should still be in very, very healthy levels. So that's it for this week. If you want to reach us, ia.ca/economy. Thank you for following us on a weekly basis, and I'll be back again next week with another edition of the Weekly Review.